the 21st century entrepreneur. What does that look like? Think about it. We've always seen stories about college dropouts. And I was sitting with a group of students a few days ago. A very interesting thing they said to me. They said, Sanjay, our mission in life is to join university and to drop out. And I said, why is that? He said, we become billionaires. So is that what the face of the 21st century entrepreneur looks like? A college dropout. We need to think about this, because is that what we want to show that our education system is not doing what it's supposed to do? Or is that what entrepreneurship means? You see, I inherited a 20th century business. I inherited that from my father. And I was asked this question when I was joining business. Sanjay, what are you going to do different to take you to that next level? Can I be honest with you? I'll tell you what I did. I almost shut it down. That's truth. 10 years ago, my father had a brain stroke. I was 24. He was in hospital, and in a span of about 9 months, I almost shut down that business. That's how bad I was. 10 years now, we are in 53 countries. So what changed in those 10 years? I spoke with my father after his brain stroke. 9 months after his brain stroke, I said, Dad, I have messed up. He said, what happened? I said, well, I've lost a lot of money. He said, how did you do that? I said, I don't know. I don't know. He said, don't worry. It's yours to lose. I said, what should I do next? He said, it's your choice. But if I had to give you one piece of advice, it would be find your purpose. Find out why you're doing what you're doing. If you find that why, and that why is strong enough, the how, the what will figure itself out. It was always about the why. So I went back, I thought about it, and I told my father, I said, Dad, I'm going to do something very crazy. But please don't ask me why. I'm going to do it. Don't doubt what I'm going to do. Just let me do it. He said, all right, it's yours to do it. And that's when I realized there are 3 different types of entrepreneurs. You have those who start with nothing. You have those who inherit something and try to create something new out of it. And there are those who try to disrupt the way things are done. So they just say, you know what, I don't like the way the system works. I want to go against the system. So who is the true type of entrepreneur? All 3 of them have different objectives. The first objective would be, I'm a nobody and I'm going to create something. So what are the things that really are needed in that kind of an entrepreneur? Purpose. The purpose to achieve something that did not exist around me. The second type of entrepreneur, a guy who inherits or a girl who inherits, should they continue that? Again, it is revisiting what was the purpose of that business. And the third one, which a lot of people talk about, is the guys who disrupt. So I need you to first of all analyze the 21st century entrepreneurship spectrum has 3 parts to it. I fell in the middle. And then I realized I want to skew towards both sides. I want to create something that did not exist, and I want to also disrupt the way my industry functions. So the 21st century is a spectrum. One of the key important factors for the 21st century entrepreneur is to identify what is their skill. What makes them stand out from the rest of the crowd. So what we call the USP, your unique selling point, I believe it is your unique positioning that matters. Second is believing that you're not the best at it, and there are people who are better than you who could work with you on that field. So identifying the fact that you're not the best. Because if you are the best in that room, you're in the wrong room. If you're the best in that room, you're in the wrong room. You have to find that reason to grow. Third most important thing about the 21st century entrepreneur is finding the purpose of what you do. Because if you get up every morning and you're still thinking, damn, this is the wrong thing. This is the wrong thing. You don't have that motivation to get to work. I met with a gentleman. He said, Sanjay, if you are doing a job, you know what's the full form of job? Just over broke. That's what you'll stay. So don't make this a job. Make this a hobby that turns money. That's the 21st century entrepreneur. So the question again came up, should technology be the 21st century entrepreneur? Is technology what's going to change the way the world functions? Technology is going to be a tool for entrepreneurship in the future, but that is not entrepreneurship. We have misaligned that fact that technology is entrepreneurship. Technology is a tool to achieve it. What is real entrepreneurship? Reality. Reality, finding what are real problems that need to be addressed. Because we now have different types of reality, don't we, Dot? We have virtual reality, we have augmented reality, and then we have the real reality. We need to find our real problems, identify those, address those, and correct for them. So I come from a business which is called financial services. Not a very easy business to do because, well, some people look down upon it. So I checked on that. Sanjay, what makes you different? Well, we identified a problem. We identified one problem. People wanted access to more information. You see, Google does that for you today, right? You want information, you Google it. But the question is, how right is that information? So we talk about big data, and then we talk about fake news, fake data. And unfortunately, the world is becoming more and more about that. So how do you identify what is real? That's where credibility comes into perspective. So I started teaching, because that became one of the ways to test my models. I've been at university for 17 years. I've done 2 bachelors and 3 masters, and I'm currently doing my PhD. Yeah, they call me an educated idiot. But university is my testing ground. When I have a strategy that comes to my head, the best place to test it is with whom? With your classmates. They tell you what's wrong with it. It's the best place. I call that incubation, yeah? And I'm not joking. Testing at university is cheaper than testing in the market. And I'll give you the simplest example of that. We have heard about United Airlines having that blunder a few weeks ago. You see how quickly that blunder turned into money? $1.8 billion of equity loss. Snapchat, the CEO, just made a blunder day before yesterday. This is all news. You see, one mistake can cost you billions of dollars. So where would you rather do the mistake? At university or in the real world? I would say do it at university. It's that incubation unit. So the 21st century entrepreneur, you have to identify 3 things. 1, who you're going to be. 2, are you inheriting it? 3, are you disrupting it? It's not necessary that you have to always be the disruptor. Sometimes traditional businesses also require leadership and entrepreneurial skills. Yes, we have talked about insurtech, edutech, fintech. That all is going to change the way we do things. And I'll give you an example of that. We have heard of something called WebMD, where you can do self-health diagnosis online. Have you heard of that? Yeah. My wife, every time she uses that, she turns out to find out she has probably got a tumor. So she coughed and she said, I think I might have a potential tumor. So what does that mean? Do we not need doctors in the future? On the contrary, because we are more informed today, we need the right advisors in our life. So doctors will have a lot more affordability, a lot more awareness, a lot more reachability because of technology. So technology is not going to take away your job, it's going to change your job role as an entrepreneur. And that's the 21st century. Our job roles are changing. They're not being taken away, they're changing. So if I could leave you with one thought, rethink your job role in this world. Thank you very much.
Thank you, Sanjay Tolani, a world-renowned speaker. Thank you, ladies and gentlemen, for attending Dubai Talks, the Talks of Dubai.
So I get the perfect session. Yeah, the session that is amazing because we just got good food. So whatever I say does not matter. The stomach is full and we all are happy. You see, when I started in this business, I was 17 and I was asked a very important question. Sanjay, why are you joining this business? And the answer is by mistake. How many of us get into our professions by mistake? Well, I got into my profession by mistake, and one of the questions that was asked to me was, why do you not regret it? Because we usually regret mistakes, correct? So the question is, why do I not regret my mistake? And the answer is, well, I got good at doing it. And if you get good at doing anything you do, you don't regret it. When I was 17, my father told me a very interesting story. He said, Sanjay, you're going to inherit a business. So yes, I'm not one of those self-made men that people claim to be. I got to inherit an empire of business. But let me tell you, that's even more tough. Because I had to start at the high, not the low. And I had to take the high to a higher, and not from a low to a high. See, a lot of people think it's very easy to take over an empire that's already running. Trust me, you're filling in shoes that are bigger than your own feet. And that's the reason why it was even more difficult to do what I do. He said, Sanjay, when you come into my shoes, you will have people working for you who have got way more experience than you, who have got a lot more education than you, who are going to be a lot more experienced than you are. How are you going to compete with that? Not only that, they're going to ask you a very important thing. Anytime they get stuck, they will come to you for advice. You see, that was the job of a leader, right? Anyone gets stuck, come to me. Now they'll come to me when I don't even know the ABC of my business. I was 24 when my father had a brain stroke and I had to inherit the business from him. I was just 24. I was straight out of high school, well, university. I did not know what to expect. 9 months into the business and I actually almost shut it down. I lost so much money that we almost ran the business down to the ground. So I grew that empire into a peanut. And I could do that in 9 months. Anyone tried that? Anyone wants to try that? It's an achievement, exactly. I did it in 9 months. And then I sat down with my father and I said, Dad, I think there's two things that's going to happen. One, either I'm going to run the business to zero, into the ground, or I'm going to go nuclear. I'm going to explode so much that people will wonder what I do. He said, what do you want to do? I said, I don't know. But I'm going to do something crazy. And that's when I reimagined my business. And the last 9 years, we have now grown into 53 countries. We have gone 1,000% in turnover. And the next year already looks phenomenal. There was only one crazy thing that I did. I reimagined what my business can do. And then we came across this whole concept. So since morning, we've been listening to disruptors, yeah? We've been listening about Uber, Airbnb. We've been talking about businesses that have revolutionized the way we do business. I had the privilege of meeting a gentleman called Nick Bontis. And I can quote him when what he told me was phenomenal. He said, Sanjay, in the 1970s, when you were in university, the total information in the world, yeah, so what we're calling about global information, used to double every 9 years. So if I looked at the total information, every 9 years, global information would double. In the 80s, that came down to 4. So every 4 years, global information would double. And that's why if you were studying in the 80s, they told you, have 4 or 5 years of work experience, come back and do your master's. Am I correct? Yeah? In the 90s, it came down to 2. And that's why a lot of the B schools said, do your bachelor's, get 2 years of work experience, you can come and do our master's program. In the year 2000, it came down to 1. And that's why a lot of B schools combined the master's and the bachelor's program, and they said, if you spend 5 years with us, we'll give you both the degrees.
This is Barry Zalma presenting Insurance Fraud for the Proformative Academy. I'm a California lawyer, a certified fraud examiner, a consultant to the insurance industry and policyholders, and I serve as an expert witness. I'm also the author of several books, including the Insurance Fraud Desk Book published by the American Bar Association. Today we're going to speak about insurance fraud. And to do so, we must first understand what insurance fraud is. Insurance fraud is a means of obtaining money criminally from an insurance company when that insurance company owes nothing under its policy. It succeeds because the insurance industry has found it difficult to prove that when a claim is presented, it was made with the intent to deceive the insurance company, such as a claim made by an arsonist who sets fire to his own home in order to defraud the insurance company. Although it is easy to determine that the fire was set intentionally, it is difficult to prove that the insured did so and intended to deceive the insurer. It is also difficult to prove that the insurer was actually deceived. That is, it did not recognize that a fraud was being attempted, and as a result paid out money either for investigation or to a fraudulent claimant, which are the elements of fraud. In simple language, insurance fraud is a lie told to an insurer with an intent to make it rely on the lie and pay a claim it does not owe. No one truly knows the extent of insurance fraud. That is because most fraudulent claims succeed. An insured who has his house damaged in a windstorm and whose contractor agrees to pay for the insured's deductible is committing insurance fraud, because the deductible is an obligation owed by the insured, not the contractor. An insured whose doctor tells them, don't worry about my fee, I will take whatever your insurance company pays, and their down payment is not required from you, is committing a small kind of insurance fraud. The insured who adds a television set to a legitimate burglary to pay for his deductible is also committing insurance fraud. These, sometimes called soft frauds, frauds of opportunity, are usually never caught. They almost always succeed, and they result in the loss of billions of dollars for the insurance industry. The best estimates I've seen from the FBI, the Department of Homeland Security, the State of California, the Coalition Against Insurance Fraud, the National Insurance Crime Bureau, all range between $80 billion and $300 billion a year for property and casualty insurance fraud. A very large range because nobody really knows. Now, insurance companies are in business to make money, and in order to make a profit from insurance, they try to limit the extent of insurance fraud and have been mostly unsuccessful. They've caught a few, they defend a few, they pay a few. And the states across the United States have seen that their citizens are losing money to insurance fraud or paying additional premiums that they would not need to pay if there was a better deterrent to insurance fraud. And instead of creating police agencies and actively investigating insurance fraud, the states pass statutes that require insurance companies to do their own investigation, to create a special fraud investigation unit called an SIU, to prepare cases to present to prosecutors for prosecution, rather than doing it themselves. This would never have been asked of convenience store operators who have a lot of armed robberies, bank robbers. Banks would never be asked to investigate bank robberies. But insurance companies are required, not asked, required to conduct a thorough fraud investigation if it's suspected. What are the types of insurance fraud? How are they limited? They're limited only by the imagination of the perpetrator. Insurance fraud is an equal opportunity crime. It's committed by every race, religion, national origin, sexual preference, financial condition. Rich people commit insurance fraud, poor people commit insurance fraud. The methods vary according to the skill of the perpetrator. Some of the types of insurance fraud that are common can be the staged loss, a fictitious claim made for the purpose of presenting a claim and obtaining money from an insurance company without right. Some of the variations include the staged theft. The staged theft of an automobile can be done where the owner would contract with an intermediary to give up the vehicle and then report it stolen. The intermediary would take the vehicle or to a separate salvor or to his own chop shop where the vehicle would be broken down into its various component parts. Those component parts sold individually have a value far in excess of the value of the entire vehicle. And therefore the salvor profits from the crime. The insured who gave his vehicle to the salvor and then reported it stolen profits from the crime and getting paid by his insurer for the value of the vehicle at the time of the theft, gets out of any lien he may have on the vehicle. Staged thefts also occur in homeowners insurance, where the insured will report a burglary at their home and claim items stolen that never existed. The insurer, faced with a sworn statement from the insured that they had lost in this burglary items of jewelry or other personal property for which they have no invoice because it was inherited, must pay unless they can find some evidence to prove that the insured created the phony theft. And sometimes that happens because people don't put a lot of effort into committing insurance fraud because it seems to be so easy. And they will break a window to give evidence to the police that there was a burglary. But because they didn't want to be seen doing it, they'd break it from the inside, and all the glass would fall outside the broken window. A good investigator, a police officer who is looking, will discover that the window was broken in the wrong direction. Burglars seldom can suck glass out of a window, and they will catch the purported false claim. But usually people aren't that stupid, and the claim will succeed. In automobiles, there is the classic abandonment of the vehicle, where the owner simply parks the vehicle with the key in the ignition in a less than nice neighborhood, tempting even the most honest of poor people to steal the car and try to sell it. He can then report it stolen, and the abandoned vehicle is gone. The insured gets paid. The thief gets to ride around in a nice car. Some insureds don't like to take the chance that everyone might be honest and not steal their car, so they dump it. Dumping is where you dispose of the vehicle in a lake, an ocean, a river, other bodies of water. In some states, cars have been found buried underground. Some lakes have had more than 50 vehicles underwater at an area where they could be driven into the water, such that the investigators can literally walk on the top of the vehicles. These vehicles were reported stolen when in fact they were probably dumped by their owner, but there is no way to prove that they weren't dumped by the thief, and therefore the fraudulent claim often succeeds. Automobile leases are an interesting method of borrowing money to purchase an automobile. And most leases have a mileage limit where you promise when you lease the vehicle that you will drive no more than 10,000 miles a year. And if you drive more than 10,000 miles a year, or 15 or whatever the contract states, you will pay as much as 15 cents to $1 a mile over the preset limit. So when an insured who leased the car because he couldn't afford to buy one finds that to work he needed to drive in his first year 30,000 miles, and would have to drive 30,000 miles for the next 2 years just back and forth to work, he can see that he's going to pay an enormous penalty at the end of the lease, because the 15 cents a mile times 60,000 miles is a great deal of money, and the insured cannot afford to pay it. So he will drive the car out into the desert or some other remote area, pour gasoline into the vehicle, and light it afire. And then he will report it stolen, and when it is recovered, they'll see it's totally burned and has no value, and the insurance company will pay the leasing company the full value of the vehicle, and the insured will avoid paying the extra lease penalties. This is a stage type of insurance fraud. Some people are not as imaginative as those who set fire to their cars or who dump them. They stage auto accidents. And as two people get together, and one will have a vehicle with 5 passengers in it, which is tapped in the rear by a co-conspirator who is insured, who will then report to his insurance company that he accidentally rear-ended a car filled with people who claim soft tissue injuries, sore necks, sprains, and strains, and that it was his fault. The occupants of the other car who conspired with him to have this accident will go to a doctor or chiropractor who will treat them for months for their strains and sprains and put together a very large claim of $5,000 to $10,000 in medical bills, none of which were actually incurred since the doctor never really treated the people, he simply created the billing. The insurance company, innocently finding its insured at fault, believing what the insured said, will pay or negotiate a settlement with the 4 or 5 claimants and go on to the next claim. People with great imagination create a paper property loss. Paper property is property that you never owned, but that you had forms or receipts or invoices that back up the purchase of items. And the way this fraud is usually conducted is a person will go into a major department store like Macy's and buy a bull of a watch with a diamond dial for $4,000 or $5,000, and he'll put down his Macy's credit card and pay for it with that credit card. And then he'll have a beautiful receipt from Macy's showing he paid $3,000 or $4,000 for a watch. He will then take the watch back to Macy's and say, you know, this is just too ostentatious for me, I'd like a credit. And the store will credit his account, and he will have paid nothing, but he will have a beautiful receipt from a major department store showing he'd actually purchased that item. He will do the same thing with other stores for big screen television sets, DVRs, video players, video cameras, computers, whatever he wants to add to his list. And never pay for anything, but he will have evidence that in the last 6 months he purchased all these wonderful things. He will then report a burglary or theft at his residence and ask his insurance company to replace the property stolen. Since insurance companies do not work in property but only cash, they will determine the cash value of all of the items claimed stolen, feel confident that they're using the right pricing because he's giving them invoices for each and every item, and go on and pay the claim. Unless someone is suspicious and does further investigation. Usually that is not done, and we'll discuss what is an appropriate investigation later. This is Barry Zalma speaking for Illumio's certified expert in corporate property insurance, course number 12, Insurance Fraud Prevention. Every insurer is concerned about fraud. Every insured should be concerned about fraud. Fraud is, to the insurance industry, an enormous drain on assets. No one knows the true extent of insurance fraud, because unfortunately most fraudulent claims succeed. The best estimates range from $80 billion to $300 billion a year, from 3% to 10% of the premium collected, which might even be a larger number than the estimated $300 billion. It is essential to making a profit from insurance to limit the extent of fraud. This is to the benefit of every person who obtains insurance, buys insurance, sells insurance, or is any way involved in an insurance transaction. State statutes impose upon insurers a compulsion subject to major fines if you don't follow through on the compulsion to work to defeat insurance fraud. Even if there is no statute, it is in the best interests of the insurer to work to reduce fraud. Fraud is a defense to an insurance claim. It can also be a crime, although there are still some states where stealing or committing fraud against an insurance company is not a crime. It is in the best interest of the insurer and all who they insure to defeat as many insurance fraud attempts as can be considered or found. What types of fraud exist in the insurance industry? Well, they are hard to limit, since insurance fraud perpetrators are highly considerate and imaginative criminals. These imaginative criminals have come up with various types of losses from which they can profit from an insurance company. One of the most popular is the staged loss. Staged losses are fictions created for the sole purpose of presenting a claim. The following are some variations on the types of staged losses. There's the staged theft, a theft where the owner contracts with an intermediary to dispose of a vehicle. The owner gives up the vehicle to this intermediary and then reports it to the insurer as stolen, knowing that the vehicle before the report has already gone to a chop shop where it has been broken up into its component parts and each of those parts sold on the open market. The thief and the operator of the chop shop know that an automobile is worth more by its separate component parts sold individually than it is as a complete vehicle. So not only does the insured profit from the alleged theft of his vehicle, but the person with whom he works and gives it up profits by selling the parts. There are staged losses like abandonment. The owner will abandon a vehicle on a city street or in a parking lot, creating what an insurance professional would call a moral hazard. The insured will report the vehicle stolen and attempt to collect before it is recovered. Usually, depending on where he parks the vehicle, leaving the key in it or without the key, it will be stolen, and the thieves will be caught after destroying the vehicle. Then there is dumping, where the owner disposes of a vehicle by dumping it into a lake or other body of water. during drought situations like California has been involved in for the last 6 years, cars have been found arising out of the lake bottom where 50 cars were underwater, and only because the lake's volume had reduced during the drought were they discovered. Cars have even been found buried underground. The insured who wishes to commit fraud by staging a loss can be exceptionally imaginative and can do anything it believes will allow it to be or receive a profit from the loss. Often, fires to automobiles result from auto leasing arrangements. Most auto leases include penalties as much as 15 cents to $1 a mile over a preset limit. Upon learning that such charges are considerable, the insured lessee will often take the vehicle to a remote location, set it afire so that it is totally destroyed, and then report it stolen. In this way, he will recover the true value of the vehicle, which will be paid to the lien holder or the lessor, and he will avoid paying the excess mileage charges, which can be considerable. If an insured buys a car with a lease that limits his driving to 10,000 miles a year before a penalty is asserted, and he drives 30,000 miles a year, he could find himself owing a great deal of money to the leasing company when he turns in the vehicle at the end of the lease. Most people who can't afford paying that penalty, who have overdriven their vehicles, set it afire and hope the insurance company will pay the loss. There are staged auto accidents where an insured person in collusion with others drives his vehicle into the rear of a car occupied by 4 co-conspirators. He reports the accident to his insurer as his fault. The occupants of the other car all claim and suffer property damage and soft tissue injuries, and he gets his car repaired as a brand new car. Paper property is an easy sort of fraud and involves property that never existed or was never owned by the insured. It can be the subject of a reported theft or burglary, so that there is no evidence, physical evidence, that it ever existed. The insured will then present photographs or invoices to establish that he purchased it. I once had a case where a great deal of electronic equipment was claimed stolen, and the insured, for proof, provided us with photographs of the items he claimed stolen. The photographs showed each of the items, and when we put the photograph under a magnifying glass, found that each item was sitting on a shelf, and directly under the item on the shelf bottom was a sign that said Best Buy Price, and then the price. The man had gone to a Best Buy store and taken pictures of various items of electronics, wrote down their values and prices, and submitted them as a claim, having claimed they were stolen, when in fact he never owned them. And he wasn't smart enough to use Photoshop to take the price tags off of each of the items claimed. Most people who deal with paper property are much more efficient and detailed. This is Barry Zalma speaking for Illumio's certified expert in corporate liability insurance. This is course number 2, how to read and understand a liability insurance policy. It is probably the most important duty imposed upon an insured, an insurance adjuster, an insurance lawyer who is faced with a claim under a third-party liability insurance policy to be able to read and understand the policy. Even though third-party liability insurance policies are written in fairly easy-to-read language, there are certain things that make it more understandable. So let's begin with the part that creates the insurance policy, and that is that it is a contract. People who wish to become a lawyer must spend 1 year learning about the law of contracts. It's a long and tedious study that we will cover in a few moments, because it is really not that difficult. It is not that complex to understand insurance contracts, or contracts of any kind. But it is the details and the nuances of contracts that cause lawyers and law students to spend a year learning what contracts are all about, and sometimes, as with my 50 years in the insurance business, a lifetime learning about insurance contracts. So, since insurance and an insurance policy is a contract, we must know the basics of contract law to survive in business and to deal with the insurance contract. So a contract is a legally binding, valid agreement between 2 or more parties, where the terms and conditions of the agreement are almost always set down in writing. Although one can enter into a contract, for instance, to wash your car orally, it is best to have a written contract if more than a few dollars are involved. And it is a requirement of the law that an insurance contract be a contract in writing. And the contract consists first of an offer to do or not do something, acceptance of the offer, an intention between the parties to create binding relations, and of course consideration, where money or some other item of value is provided from one party of the contract to the other. It becomes legally binding when consideration is paid for the promises made, and where there is proof that the parties have the legal capacity to act. My 5-month-old granddaughter, as lovely as she is, does not have the legal capacity to enter into a contract, since she cannot even speak at this moment. A person with Down syndrome may not have the legal capacity to act. A person with dementia or with Alzheimer's disease certainly does not have the legal capacity to act and to enter into a contract, since they have no idea what the heck is going on. Genuine consent of the parties is required, and for there to be a genuine consent, the parties must have the ability and capacity to understand the terms of the contract. And the contract must be legal. For example, if I enter into a contract with you whereby I promise to pay you $10,000 if you spread gasoline throughout my home and burn it to the ground so I can get money from my insurance company, that's not a legal agreement. Or if I offer you $50,000 to murder my girlfriend or my wife, that is not a legal contract. It cannot be upheld. You cannot sue me to get the money. An agreement that lacks one or more of the elements is not a valid contract, and therefore is unenforceable. Every businessman, anybody who's ever been in business, knows that insurance is necessary to the operation of the business because the risk of loss by suits claiming such a thing as products liability can destroy the company. A $100 million verdict against you when you only make $100,000 a year in gross sales will destroy your company manufacturing widgets. But an insurance policy protecting you against that lawsuit can save your company. So, if your conduct can in any way be negligent, and that means breaching any of the general duty of care imposed on all of us to do nothing with our person or property in such a way as to harm someone, then you need insurance to protect you against your negligence, because no one is perfect. No one drives his car without getting into an accident eventually. No one walks and talks at the same time while chewing gum and gets into an incident that might cause an injury to someone. No one in the business of building things like homes or factory buildings can be absolutely perfect, and there will be defects in some of the buildings you construct. It is best to have insurance to protect you against that exposure to liability. Bodily injury cannot be avoided, but the cost of bodily injury to third persons due to your negligence can be avoided by insurance. Leaving a wet floor where someone will trip and fall and strain his back and cause him serious pain allows the insurance company to be used by the business to spread the risk of that loss to the thousands of people the insurance company insures. So that if this gentleman only falls in your place of business, but not in the 30,000 other businesses the insurer has agreed to insure, then it can still afford to pay to defend and indemnify you and still make a profit, because the others have no need to make a claim. Now we start understanding an insurance policy by filling out an application for insurance that we talked about somewhat in the course number 1. The application is designed and used by insurers to understand that you, the person seeking insurance, is asking for an offer for insurance that will protect it against certain liabilities. And therefore the application contains information that is needed by the insurer to determine if the applicant is an appropriate risk. Now, some insurers use standard form applications. which are consistent throughout the industry. Some use manuscripted type applications that ask particular questions that are particular to the types of risks that insurer insures. And it relies upon, and has every right to rely upon, you, the person who seeks to be insured, for sufficient information to allow it to determine whether it is willing to insure you against those particular risks of loss. And in so doing, it tells the insurer the name of the person seeking insurance. And if it wants to do additional investigation, it could go to Google or Bing or any one of the hundreds of search engines to see what it can learn about you that is publicly available. It might even go to your social sites like LinkedIn or Facebook or Twitter to find out other information about you, which it couldn't find out without your full name. It tells the insurer the various liability exposures you face. It tells them about your claims history, and it gets representations concerning you that the insurer needs to make its decision. If the application provides information sufficient for the insurer to decide whether it's willing to accept the risk or not, it will simply issue an offer. If it doesn't provide enough information or spaces are left blank, the underwriter who is charged with making a decision at an insurance company as to who it would insure and who it would not, then will send an email or a fax or a letter asking for additional information, such as you report a loss on April 6, 2016. Please give me the details of what happened that caused the loss and what was the result of the claim presented to your prior insurer. If everything is fine, if they think they have enough information and they can rely on the truthfulness of your answers in the application, the insurer will make an offer to insure. And that offer will describe the coverages available, and it will advise the prospective insured. For example, we will insure against your exposure to claims of bodily injury, property damage, personal injury, with limits of liability of $1 million if you pay a premium of $1,350 a year. It's a simple, straightforward offer. You, as the insured, then have the opportunity to either accept the offer as written or propose a counter offer where you are making a change in the policy or in the premium paid. Then the insurer can either accept or reject your counter offer. You and the insurer can also agree on limitations of the coverages provided. You could do this, and the insurer will add or subtract certain exclusions, that is, statements in the policy refusing to insure against certain specific risks of loss, such as they refuse to insure against the risk of loss of an assault or battery by you or any of your employees, or they refuse to accept the risk of loss of injuries caused by your negligently polluting property, or they could exclude the risk of loss of you're defaming someone. They can exclude or include coverage as they wish. The offer might also contain conditions, promises made by the insured that must be met before insurance can apply. These conditions could include things like the hiring of a risk manager, or the conducting of safety meetings monthly at your locations of work, or of hiring security guards to protect your patrons. They might also attach warranties. Warranties are more strict conditions where the materiality of the promise made in the condition is presumed, and where the basis of the insurance policy itself is the warranties, so that if you warrant that you will only sell your product in the United States, and you have a loss resulting from the sale of a product, say, in Bangladesh, you will find there is no coverage for the injury caused by that product sold in Bangladesh. The offer is almost always made in writing, although it can be oral. It explains all of the types of coverage to be provided. It explains the amount of premium the insurer requires to be paid as consideration. It explains the conditions that must be met by the insured before the policy comes into effect, such as a signed application that is attached to and forms a part of the policy. And then that offer is presented to you, and you can either accept or reject the offer. Now, when there is more than one offer, after submission of an application to multiple insurers, you as the insured or your broker acting on your behalf can compare the various offers. And as you compare them, you determine which offer provides the most coverage for the lowest price. And if you can't do that, or your risk manager feels unable to do that properly, then seek the advice and counsel of your agent or broker to review the various offers and determine which is best for you based on the coverages provided and the premiums expected. You should also compare the economic viability of each insurer making an offer. Check the best rating of the insurer and hope that it has at least an A or A+ rating. Check with the insurance department in your state for the rating of the insurer. Determine whether that insurer has been admitted to do business in the state and is protected by an insurance insolvency statute. Check whether the insurer has been disciplined by the Department of Insurance for its wrongdoing to members of the public. All of these things should go into your consideration of whether or not to accept an offer of settlement or an offer of insurance. After completing the analysis of the various offers, you as the prospective insured can accept one of the offers, reject all of the offers, or make counter offers to see if you can get a better deal by reducing the coverages available or by reducing the premium you're willing to pay.